Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson. Joining me on the show today is Louis Dubin, principal and managing partner at Redbrick LMD. They are a real estate developer with a pipeline of Opportunity Zone projects in Metro Washington, D.C. Louis, welcome to the show.
Thank you so much. Thanks for having me.
Absolutely, Louis. Pleasure to be here with you today. You and I met at the IMN Family Office Real Estate Conference in Dana Point, California back in June. You were on the Opportunity Zone panel with me. It was great meeting you there. After our panel, we got to talking at the cocktail hour later that afternoon about optimal leverage on an Opportunity Zone deal. You had some really interesting thoughts there. So how are you guys utilizing leverage on your deals at Redbrick, and what in your mind is the optimal amount of leverage to do an OZ deal, and how do Opportunity Zone compliance issues kind of play into that?
Sure, great question. Well, first and foremost, typically we believe less leverage is always better. It de-risks a deal. Let's remember you have to substantially improve to qualify under the OZ rules when you're dealing with real estate. And with that substantial improvement test, usually it's 50% or more. I won't go into all the specifics, but you're constructing things, and very often you're constructing new buildings. In theory, you could take an old building, and if the ratios work, you could substantially improve an old building and qualify. But most people build new buildings, and there's always substantial risk in building something new. So we like lower leverage as opposed to higher leverage, especially in times like today, where your guess is as good as mine, where inflation's going to fall out. There's been huge construction cost inflation, and low leverage we think is like a really prudent thing. So we're typically 35 to 40% leveraged in the construction phase, which means 60 to 65% cash equity, old-fashioned, not preferred equity, not mezz. 60 to 65% is Opportunity Zone capital, with 35 to 40% being debt. And it's interesting, and it's not intuitive, but because of the OZ rules, where you typically have to have your capital in for 10 years and a day, proceeds of refinance, if you've held for at least 2 years, come out tax-free up to 100% of your original investment. So if you have a lot of cash, a lot of equity in the deal, when you go to refinance after you've finished your building, most of the capital in that refinance is going to go to pay back the equity and not the debt. And in a higher leverage situation, you'll be lucky to get 10 to 20% of the equity out if you're leveraged at 75, 80%. So by going with very large amounts of equity into our deals, most of the capital should come back once we refinance in year 3 or 4, once we've completed and leased up the buildings, as opposed to waiting until year 10 to get most of your capital with all your capital back. So for all those financial people out there, do the math. If you're getting most of your capital back in year 3, 4, versus waiting until year 10, 11, 12, it actually generates a higher IRR by putting in more equity capital. Now, there's a limitation to it. You can't you can't receive back more tax-free than 100% of the initial investment. So the magic number, we've had our finance people run it a number of times. In theory, you could really go as low as 20, 22% debt to equity. At some point, you can't use all the proceeds that you'd get out. For instance, if you went 100% equity, not all those dollars will qualify the way that I'm describing. So the magic point is 22%, and we've chosen around a 35% target. Sometimes it'll be 36, 37, 38, could be a little less than 35, it all depends. But it's accretive. It's accretive to yield.
Yeah, I'm sure it is. And I'm sure, it kind of depends on the economics from deal to deal, how much
Mm-hmm.
leverage that you want to put in. But that's, I mean, even at 30%, 35% or so is fairly low leverage. Are other, or do you see other developers or other asset management firms who are providing financing for deals coming in with that low amount of leverage, or are you unique in that regard?
Um, I think we're pretty unique. I think we are lower leverage than most, but we also have a unique circumstance. Um, all of the land that we develop on, we already own. So it comes in at a new basis. And sometimes it comes in vis-a-vis a ground lease. And certainly a lot of stuff was coming in vis-a-vis ground lease before the new clarifications came out last fall, winter. Now we're going to a fee simple structure, but some of your viewers may recall that once upon a time with the earlier rules, it was uncertain on whether a fee simple deal would really work if you were a previous owner, and the ground lease structure was preferable for many of the law firms and accountants. Today, with the new clarifications, we're confident in going fee simple. So it does depend on whether you're putting the land in subject to a ground lease or fee simple in terms of leverage rates as well. There's a lot of different factors.
Interesting. Well, the one thing I really like about your model there, Louis, is, well, on top of the fact that it bumps up the IRR, on top of the fact that it increases the yield in the long run, is that you're getting more liquidity back to your equity investors right before that crucial time when they have to
Absolutely.
recognize that initial capital gain that they rolled over into your investment fund, right? They have a tax liability that comes due in spring of 2027, recognizing
Mm-hmm.
that capital gain in 26, and now they've got the liquidity to actually be able to pay it off, I think, which is pretty thoughtful, right?
Yeah, I think it's really thoughtful. I just think it makes sense. It makes sense. My partners and I tend to be, major investors in what we own, and makes sense for us. And we think it makes a lot of sense. We'll go to higher leverage points, 65, 60 to, well, 60 to 70% once we have a stabilized asset. There's no reason not to use, if leverage is accretive, not to use leverage 60 to 70% if you already have stabilized cash flow in place. And
Right.
most of what we're building are multifamily apartment buildings where we've only seen rents increasing in our market. And we also build office buildings if we have a substantial pre-lease for the building with the tenant that we're comfortable with a long-term duration. And one of the buildings we're just finishing is to a healthcare system that took 100% of the building, which gave us the confidence of building an office building, actually starting during the pandemic, a new office building. How do you like that? But it was for a healthcare system and clinic, which physically needs to do research and see people. So that made a lot of sense. But typically what we're doing is an awful lot of multifamily. DC is unique with defense, intel, security, and cyber. And we're seeing a lot of growth there. So we're also in the midst of putting together the new National Cyber Security Leadership Center, which we're working with a number of different institutions to put together, both academic, government, quasi-government, and private sector, right around the cybersecurity research and workforce development space. So we will do office buildings, but they must be substantially pre-leased for us to
Sure.
do. Or the default is in our portfolio is multifamily unless we have an office user.
Sure. Well, that
That's the
makes a lot
default.
of sense. That makes a lot of sense these days, right? I want to talk more about the property types that you're developing, why you like multifamily, when office makes sense. Let's get back to that point in a few minutes here,
Yes,
Louis.
sir.
But you mentioned the high level of inflation a minute ago. We're recording this episode in the middle of July, so we actually just got the CPI print from, I think it was yesterday or the day before. 9.1% is what inflation hit from the same month last year. Just incredible. Highest level of inflation in the last 40 years. I think I've been saying that for the last couple of months now, but it seems to be getting worse and worse, obviously. On top of that, there's supply chain issues, interest rates are going up. Pretty turbulent economic period that we find ourselves living in these days in the middle of 2022 here. Louis, have any of these factors, high inflation, supply chain issues, interest rates going up, looming recession, excuse me, possibly. What impact has that had on your operations at Redbrick? Have you noticed any delays or any modifications, or are projects needing more funding now? What can you tell us about the impact of our current macroeconomic climate on what you guys are doing?
Excellent questions. Let me start with the last. Projects needing more funding. Our low leverage strategy really works well in this kind of environment. So we're pretty well suited with the low leverage, because I think banks are getting more and more reticent to go further up the capital stack in how much they'll lend you. So there we're good. I think that there are lots of challenges to develop today. There'll be lots of people that won't be able to deal with those challenges and won't build their buildings, which is sort of, there'll be less supply out there. And we believe, and in Washington, D.C., we're very fortunate to have a high growth market in terms of job growth. It's all about jobs. People are working. People need places to live. We can debate how much space they need to work. Most of our buildings today are substantially designed for people that will be spending time working from home. 80% of our units today have substantial balconies, at least 6 feet deep. So there's some certain mitigants of what's going on today. And one of them is designing buildings that are appropriate for today. But going back to inflation and the rest of it, sure, the cost of borrowing is more. But at the same time, the rent trade outs, we have a few thousand apartment units that we own, and the rent trade outs are as much as 10% these days. So we're seeing huge price inflation on rents. That shouldn't be new news to most of your viewers. We're reading about that. I don't care if you're where you are in this country. If you're in a vibrant market that has, job growth, you're going to see these crazy, wacky rental inflation numbers. So we feel pretty good about that we're seeing higher rents. Without those higher rents, you couldn't build buildings at today's higher cost. And those higher rents are tracking. So that's a good thing. In DC particular, we're absorbing all of the tremendous amount of new units in Washington, primarily around the Navy Yard. That's sort of the Capitol Riverfront, sort of the dominant place. But inflation is a very real thing. Low leverage, teams that really know what they're doing. You need high job growth markets, for lenders to feel good. Supply chain is a very, very good question. I don't know. We certainly aren't sourcing materials from Ukraine today, and maybe not Latvia. And I'm not saying that facetiously, but we're really taking a good hard look on where the materials and where our finishes are being sourced from, and making real-time decisions on, is it worth the supply chain risk if it's coming from a far distance. So these are very real things that you're dealing with when you're building buildings that are hundreds of millions of dollars each. So you can also afford to put in professional time to go through that. And costs have risen. And in some cases, costs have risen, extremely. We think that that's temporary with a lot of the commodity pricing, because most of the major commodity pricing, as you may know, has come down substantially. And we think the market is still lagging on today's contractor price versus where that price may be in a few months. So the last 20, 30% of what we're buying in a building, like finishes, for instance, cabinetry work, maybe even appliances, not switchgear, but stuff that you put in at the end. We're going to hold off on buying some of that because we think those prices are going to come down significantly because of inflation, higher cost of borrowing. Less projects are going to get the green light. The contractors won't be as busy. Um, and that's sort of our strategy there. So we're going full speed ahead. Investors continue to like the multifamily space, whether it's OZ or otherwise. OZ, they love the tax benefits. We all know how unbelievable this 400 to 500 basis point benefit is, because the sovereigns decided to put a program together to give you that benefit. So we're feeling good, but we're working much harder. We're working much harder to finalize our budgets on our buildings, on our structures today. But we think there'll also be less competition.
Yeah, fair enough. And it seems like you see light at the end of the tunnel too, right? With regard to rising prices, maybe some prices are starting to stabilize. In terms of the rising costs that you're encountering, is it mostly materials costs that have gone up that have impacted you, or is it the cost of labor? You mentioned contractors, or is it a little bit of both? I mean, what's really more responsible for the rising costs for you guys, at least?
I wish the contractors would be more transparent. We're trying. We're
Mm-hmm.
trying very hard to get that exact transparency, because if we know, for instance, copper and electrical wire and lumber, for instance, has come down on a commodity pricing, and we're being quoted commodity pricing numbers based on a few months ago where that price may have fallen out. Then we're basically putting it to contractors today. Prove to us, show us that you're paying labor that much more. And I don't think that's the case. I think for a little while, the contractors were allowed to take this supply chain hysteria and charge whatever the heck they wanted. So we are fleshing that out as we speak. We are demanding line by line item transparency on the labor component and the commodity component.
Yeah, well, that makes a lot of sense. That's interesting. So it's no longer a case where you're just seeing one bottom line number that you have to write a check for. You actually want to see what goes into that number a little bit
If
more.
I took you through what we do, we have a whole construction team internally. Mm-hmm. And our head of construction, one of the greatest construction executives in the country, he started life, thankfully, as an estimator once upon a time. And they are literally going through, because we just don't believe it. We're rational people. It just doesn't make sense. If all these commodity prices are coming down, then prove to us that now labor is making double the wage they were making a year ago. I don't believe it. We don't believe it. We don't see that.
Sure.
But we'll see. We'll see. The buildings still pencil. They still make sense. Again, because the rents have caught up with all of this. And I think there'll be less deliveries of buildings than we were forecasting a year and 2 years ago.
Because it's more costly to put them up.
And if you're leveraged, if you have 20-25% equity and you're going with the super leverage, it doesn't work today.
Right. And have you had to adjust your fundraising numbers? Have you had to raise more equity for some of your projects than maybe you would have thought a year or two ago?
I can't really talk about fundraising. What I can talk about is construction budgets. Okay. And construction budgets absolutely on a number of projects have gone up. But at the same time, so are expected rents. So it really hasn't diminished or hurt the
it hasn't changed how the projects pencil out.
Yeah, the projects still pencil out.
Yeah. Any other challenges that you're facing these days we haven't covered yet?
It's always challenges. The supply chain, figuring out where you want to buy, your big component parts from. The other big challenge is we have gone to a net carbon zero from operations cornerstone in all of our new buildings. It's really important, because not a lot of people are doing that. Everyone's talking about it. There are a million conferences. A lot of people are getting educated on it. We've been getting ourselves educated on it over the last few years. There's a lot of competing standards. What's the right outcome? How do you measure yourself? It's a whole new brave world, this carbon neutrality world, and it's dead real. And there's a big challenge in understanding what the right metrics are to apply. Like, for instance, years ago, for many years, we all used the LEED standard. LEED gold, LEED platinum, I don't think lead silver even exists anymore. Maybe it does. But, that was the standard for many years about a more environmentally responsible building, right? We all sort of knew that. There was a lead standard. We don't know what that new standard is or what that standard is. There's a number of standards, ILFI, number of competing standards for net carbon zero from operations. What does it mean? How do they exactly, they're going to score it? How subjective is it? So we're learning new vernacular. We're learning a new way of building buildings that are more carbon neutral and more carbon friendly. Big challenge. Conferences, learnings, readings, technology, different HVAC systems, different mechanical, electrical, even the plumbing, the water usage. So it's cool stuff. So I really feel like a kid again, learning a lot of new stuff. I think next week our whole team is going and learning about wastewater and sewage and how to tap that energy from the warmth that effluent creates, and how you harness that. And all these things adding up goes into a more energy friendly and carbon neutral building. So that's been a challenge. And one of our other big challenges is we are designing right now what we believe will be the first carbon neutral building, not from operations, carbon neutral building in the building of the building, which will be 130 foot tall apartment building made out of wood, cross laminated timber, CLT. To your readers, read about it. You heard it from me if you hadn't heard it before. You see a lot of this in the future. And to go 130 feet is not permitted in most codes in most cities in the US today. So you literally have to have a progressive city that's willing to use an international standard into the future to give you the waivers and the abilities to build these buildings out of
You're not
wood.
allowed to go that high with timber in most places. Is that what you're saying?
Yes, sir.
Right.
But the fire rating on many of these buildings is higher than steel and concrete.
Okay. Because it's CLT, not just regular wood timber.
Yes, there is a technology. It's sort of a cross laminated. It's like a glue lamp for those that know construction.
Okay.
It's like an interwoven beam. If you've been in some old mill buildings that were built out of wood years ago, and you can sort of picture that. This is a technology and a coating that gives you because of the density and the structural density of the materials, a very high fire rating.
So then not just the operations of the building once it's in service, but the actual construction of the building is carbon neutral or net carbon zero?
Exactly.
Interesting. And why is that important to you guys at Redbrick LMD? Why are you undergoing the development of these net carbon zero buildings?
We think it's the right thing to do, and we think it enhances long-term yield. We believe there'll be carbon taxes on buildings that don't do this. We think that we will be dinosaurs and obsolete for buildings that aren't doing this 10, 15, 20 years from now. And since we're long-term holders, we think this is the entire direction that the urban larger buildings are going in or will go in. I think we're a little ahead of the curve. But if we have a 10, 12, 15-year view, we think it's the responsible thing to do to be asking ourselves what our investors are going to want to buy in 10 to 15 years. And we think they will all pay a premium if you've delivered a building that is net carbon zero.
Interesting. Yeah. So to avoid possible future carbon taxation, are you getting any net zero carbon tax credits for what you're doing these days? Do those even exist, or is that are you a little bit too far ahead for that?
None of that is a meaningful component of the finance of this, although there's some energy financing for CPACE. There's some energy programs for smarter, greener, more efficient energy, but that really isn't part of the equation. It's really quite simple. When we go to sell our buildings in, say, 12 years, we believe that if we aren't net carbon zero from operations, we don't know if it's 50 basis points, 75 basis points, 100 basis points, but we're going to trade at a much higher cap rate than someone that built carbon zero from operations.
Sure.
And, anything over 50 bips in terms of difference in value justifies spending the extra dollars today to do what I'm describing. We also believe that if we're building buildings that are net carbon zero, those will trade for even more of an enhanced premium than just carbon zero from operations. So yeah, we think it's smart business, and a lot of people agree with us. Yeah. And then there's a whole impact side of the world in investing that that wildly agrees with us, both for economic and for their own sort of environmental and social take on the world.
Sure. No, that makes perfect sense. And, think what you want about the importance of being carbon neutral and impact investing. It's those are politically charged topics, but the fact of the matter is there is a business case for what you're doing, and you've got a long-term vision there. So I think that makes a lot of sense, Louis. Wanted to shift gears and talk more about opportunity zones, specifically in your backyard where you guys are doing all of your development in Washington, D.C. And I'm pulling up on my other screen over here right now, OpportunityDB. We've got a page about Washington, D.C.'s opportunity zones. I'll make sure I link to it in the show notes for today's episode, but it looks like there's 25 opportunity zones in Washington, D.C., mostly concentrated east of the mall on the east side and a little bit in the southeast as well. What can you tell us about Washington, D.C.'s metro opportunity zones, Louis? Where are they located exactly? What's the market like? What kind of buildings you're doing in O zones there? Tell us everything you can about Washington, D.C. and the state of OZ development in Washington, D.C.
So I would say the vast majority of the opportunity zones in D.C. are in Southeast D.C., as you said. And D.C. is a little bit different as a city because of the height limitations. For the most part, you're limited to 130 feet of height in Washington, D.C. So once the city, which is really current, is built out or is being occupied by residential, very hard to move people in Washington, all the rest of it. You really don't have any more terra firma for growth. You don't have land. The last remaining land for growth, for the most part, was in Southeast. And that's why the Fed, starting about 15 years ago, 10, 15 years ago, and with the privatization of St. Elizabeth's, which was an old federally owned hospital, half went to the federal government, the other half went to the District of Columbia to redevelop. Homeland Security built and opened just before the pandemic their new headquarters in Southeast. So they moved from Northwest, their headquarters, to Southeast. And with that, the Coast Guard headquarters moved just before them as well. Customs and Border Patrol is coming. ICE is coming to that campus as well. And the new Cyber Command, CISA, Cyber Infrastructure and Security Agency, is built as we speak. This was one of the last places that had land to build large federal or other projects in the District of Columbia on Metro. This was like it. Because DC is small. It's not a big territory. And those jobs really drove an awful lot of infrastructure needs in this area that historically really was just not given its fair share of funding and was sort of passed over and overlooked. It also happened to be historically, for the last 50 years, amongst the lowest income areas in Washington, D.C. So you had this confluence of land being available, the feds basically taking a lot of it for the federal growth in security, as I said earlier, and cyber. And around that, there were housing needs, shopping needs, food needs, healthcare, all kinds of needs. And so a lot of the opportunity zones in DC are fulfilling the needs of workers and jobs that have located before the infrastructure came. It's really quite interesting, unique. And that's because there just wasn't much land left in the District of Columbia. So it is an incredible market for investing. The Opportunity Zone overlay really was important because it took a lot of people, got them very focused on, hey, is there an opportunity here? Because if there is, this is very tax efficient. So people that otherwise maybe weren't looking at Southeast for 50 years, it was sort of like a pariah location. And they scratched their head and said, wait a second, the last 10 years, is that right? $30 billion was built at the Capitol riverfront, or probably know it as the Navy Yard. $30 billion down there. $30 billion in DC, in an area that when I was a kid, there was no reason to go to. Maybe you'd go there to buy a used tire or old warehouses. And certainly you wouldn't go there at night. It was sort of it was not a place to go. So all this transformation happened, and it happened in Southeast. So you have some of the most expensive rentals and neighborhoods now in DC, in Southeast. The rents in Southeast far eclipse the rents, for instance, in Bethesda, Maryland. A lot of your viewers may know Bethesda. For many years, that was one of our major mega, suburban markets that people paid, very fulsome rents at. Capitol Riverfront is much higher. Right? It's 30% or more higher than Bethesda today. So this is where people want to live, work, and play. They have easy access to jobs. And we're talking about sites that are a mile, 2 miles, 3 miles from the Capitol. So very close in. And it's very exciting to be part of it. There's also a multi-billion-dollar infrastructure program with a new bridge, with new infrastructure tunnels, with new highways, with new interchanges. It's one of the biggest infrastructure improvements in the history of our region.
And that's the area that's just right over your shoulder there, if I'm not mistaken, right?
Yes, exactly. Here we go.
There it is.
Other side. There's the new bridge.
Yeah.
So it's exciting. It's exciting. So the buildings that we're building are heavily tilted to multifamily. We currently have about a pipeline of about 4 million feet to build that we currently own. This is dirt that we own that we've acquired over the last 10 years. And we're building an awful lot of multifamily rental, typically with a 12% affordable component. And we're building office buildings when we have an end user like this healthcare system I was describing that'll be moving into their 132,000 foot building on the campus, the private side campus in St. Elizabeth, across from Homeland Security. I think we give them the keys for their space in November, this coming fall. So we'll build office buildings if we have a long-term tenant that commits to the building, all or most of all the building.
And yeah, well, so thanks for let's get back to your buildings a little bit more. I know you can't talk about your fund or your fundraising, but we can talk about some of the buildings and your pipeline.
Sure.
You spoke about it a few minutes ago. We're getting back to it now. Tell us more about your pipeline. How many construction projects or potential deals do you have in it? And you mentioned you're doing mostly multifamily, but I think there's also some office in there as well that you touched upon a few minutes ago as well. Is that right?
Yeah. We currently have over 10 sites that we own. We'll go vertical on a couple of them, new sites a year, 2 or 3 that could be faster if we were to sign, for instance, a major office tenant. And those sites are located in Southeast, primarily right across from the Capitol Riverfront and the Nationals ballpark. A lot of your viewers probably know the ballpark. There's also a new soccer stadium, and the district right before COVID, about a year before COVID, developed and delivered the new entertainment and sports arena right next to us in Southeast, in St. Elizabeth, which is where the world champion Mystics play now. Because this has become a big entertainment area for the district as well. Get our soccer stadium, our baseball stadium, our arena where the WNBA plays. It's also one of the
Is that a different arena from where the Capitals and the Wizards play?
yeah, they play downtown in seven. They play at the
Okay,
at Capital One Arena.
gotcha.
Um, but this ESA, Entertainment Sports Arena next to us at St. Elizabeth, is also where a lot of the major worldwide gaming competitions, the virtual gaming competitions, take place. So they built it as a virtual gaming arena as well. So it's pretty cool. That's about 100 events a year typically.
Hmm.
And it's added an awful lot to the neighborhoods that we're developing in the Southeast.
No, very
All these
interesting.
together, but this one especially you can walk to from
Yeah,
most of our.
that's no, that sounds really neat. So I was actually just in that part of DC a couple weeks ago with my family. We went to a Nationals game at that Nationals ballpark. I know it hasn't been there very long, but I had no idea that part of the city was as run down as you were describing. Maybe 30 or 40 years prior. It looked brand
Actually
new and
15 years 15
15
years
years, really interesting.
15 years ago. Yeah, it's an epic story. Harvard and many universities are doing case studies on the Capitol Riverfront now and what's happened there and how do we study that and all the rest of it. It's pretty interesting. Where'd you go to dinner when you were down there? Like, you share with your viewers if you went somewhere particularly good.
Oh, where did we go? I think we found some Italian restaurant actually up on the other side of the mall, up in the more central part of DC. I don't think because it was a day game, so
Got it.
we got
Hey,
out of there and headed back up across the mall to where we were staying. I can't remember the name of the restaurant now, unfortunately,
some of our
but
top Michelin star restaurants now in DC are in the Capitol Riverfront.
hmm.
Like
I'll have to go back. I'll
unbelievable.
have to go back and check that out next time I'm in town.
And the Standard Hotel from New York is at the is in the Capitol Riverfront.
Hmm.
You know, it's a big coolness factor.
Great part of town down
It's a
there
great
these
part of
days,
town.
I'm sure. Another topic I wanted to bring up, Louis, right before we hit the record button, you mentioned to me that you're on the board of New York Common, which is one of the largest pension plans in the United States. What are some of your insights that you have with your experience there with that large institutional quality investor? What are and you probably can't talk about their strategy in detail, but what type of trends are you seeing from the institutional side of things?
Yeah, multifamily is still very strong in a leading food group for institutional investors. It surprised me, but finally logistics, still quite popular, but it has lost its shine. It isn't quite the shiny object that everyone has to pay up for right now in terms of logistics. I don't know if that's supply chain or what, but for a long time, simple warehouses and logistics centers were like, the golden egg of real estate. So I think we've returned a lot to multifamily. It's always been, the commodity food group in real estate, multifamily rental. I think the fact that in most markets, the rent trade outs are quite high. You're seeing rental inflation that's very real. I think that smart institutional investors have more comfort in that asset type than in other asset types today. There's lots of talk about repositioning strategies, retail and office, and what have you. I'll tell you another area that is quite interesting that I think the institutional world is paying some attention to is limited service hotels and some of the hospitality plays. This was a sector that got really terribly hurt during the pandemic. And there's some major opportunities on recapitalizing some of those companies today, as you would imagine, that were seriously denuded of a lot of their cash.
Mm-hmm.
So multifamily is still the go-to food group, in my opinion, and I expect we'll be seeing more and more opportunities, whether it's value add. Now, ground up, I'm not so sure about on the institutional side. There's a lot of variables and factors like supply chain, like what's your final GMP going to be. It's really hard to nail down exactly today. So I think core multifamily, value-added multifamily, even workforce housing are still attractive to institutional investors.
Sure. That makes perfect sense. And, it's a good market. Everybody always needs a roof over their head. In most markets all over the country, there's a huge undersupply of
Hmm.
housing, of multifamily. So, yeah, I'm a big multifamily fan myself. My listeners and viewers of this podcast, that should not surprise anyone there. I think there's a lot of positive trends, obviously, for multifamily. It seems to be the most popular property type for opportunity zone development. Like you mentioned at the top of the episode, mostly new construction, just because of the way the opportunity zone statute is written. It's tough to do substantial improvement on multifamily in most areas around the country. What about office though? Office seems to have taken a step backward with the pandemic. A lot of workers not returning to the office.
Hmm.
I read an article in the Wall Street Journal, I think earlier this week or last week, about some of the different markets in the country and how they're returning to the office. And where I am in Texas, we seem to be leading the way in areas like Dallas and Austin. But even still, it's only at a level about maybe 50 or 60% of where it was pre-pandemic. Where you are, Louis, in Washington, D.C., the federal government's one of the biggest tenants of I think actually the biggest tenant, correct me if I'm wrong, of office space in the DC area. You guys
Hmm.
are hovering maybe at the 20 or 30% level, kind of lagging behind the national average in terms of returning to office. What are your thoughts on those trends, and when does office make sense to develop as an opportunity zone developer?
We think that people's apartments, rental apartments, are going to be the proxy for office for an awful lot of people. So we're designing our apartment buildings for live and work and play. So the amenities are play, the apartment is live, but the way we've designed it, the way we have fashioned it, the way that we've put Zoom rooms on floors, in dedicated spaces and dedicated places where people can go and work like they're at a WeWorks or what have you. We think that that's really important in our residential buildings, and that's how we're dealing with that trend, which is why you're going to see, I think, a lot more apartment buildings built, on our dirt than office. However, let's go back to cyber security, intel, and defense. DC also has a number of sectors where it's important to be in a secured space. Individuals have to go check their phones, little cubbies, and they go to work. And it doesn't matter, whether you've watched, the TV show 24 or Mission Impossible or any of these shows, but that's very real in DC, or the Pentagon or what have you. There's a lot of DC that takes place in person. Not all. If you're working for the agriculture department, probably not as much. But in many other sectors, you're going to work, and some of those groups, like there's no surprise that we're working on the National Cyber Leadership Center. Why is that? That's because um, cyber needs. It's really interesting. Certain physicality. There are things called cyber ranges, where in the National Cyber Leadership Center, we're going to be teaching offense and defense. So you're an attacker, you're a defender. And it looks like something like at a NASA, these cyber ranges, people at desks and people yelling out, and there's an attack and you're trying to thwart it and see what's going to work, and how do you land the person on the moon and all the rest of that kind of thing. Those take physical spaces. They're still being designed. They're hardwired. They're in a government intranet with black fiber loop, and you can't black fiber and dark fiber people so easily in their apartments.
Yeah, that type of
So
thing for security issues has to take place at a specific location. That makes perfect sense.
those will be the kinds of buildings we're building. I'm just being really candid that those are the kinds of things that we do, and those are the kinds of office buildings or a healthcare system. We have a new hospital being built next to us on one of our sites. There'll be other healthcare and other offices where you need the physicality of going somewhere and having a procedure done or what have you. Um, So that's where I see it in the future in DC. But you do have these bespoke, specialized needs in Washington, which will mean we'll be developing, every year or two, a new office building for one of these unique users I'm describing.
Oh, very interesting, Louis. Well, it seems like we're out of time for today. I think we've covered everything we wanted to, Louis. It was a pleasure speaking with you today again. Before we go, where can our listeners and viewers go if they want to learn more about you and Redbrick LMD?
Redbricklmd.com is a good place to start. And if people have specific questions, go on our website. You'll get my email address, and happy to send you a note.
Fantastic. And as always, for our listeners and viewers out there, we will have show notes available for today's episode at our website, opportunitydb.com/podcast. And there I'll make sure that we have all of the links to the resources that Louis and I discussed on today's show. And please be sure to also subscribe to us on YouTube or your favorite podcast listening platform to always get the latest episodes. Louis, again, really appreciate your time today. Thanks so much for being with us here today.
Thank you. Stay healthy. Have a great summer.